Okay, so what we're going to talk about, we're going to start with the fundraising process, how to get investor ready, cap tables, equity splits, and then we're going to go into startup valuation. What are the latest valuations for pre-seed seed, how to calculate your funding ask, setting your startup valuation, either safe and convertible notes, and then how to structure your pitch. So yeah, Jenny, take it away.
Sweet. All right. Fundraising. Fundraising is so much fun. Not really. I don't want to cover too much of the things that you can find online and probably the things that you've heard many people say in a lot of the sessions I'm sure you go to or the events you go to. So one of the things that I wanted to cover is we make decisions emotionally. Oh, actually, I probably should share a little bit about me. Hi, my name is Jenny. I am the managing director of Founder Institute. It's something I do on the side. During the day, I help venture capitalists turn around their portfolio companies. We also invest. We do pre-seed to Series A companies. I'm actually starting to look at some Series B companies. My background is I'm a geneticist by education, behavioral psych, went over to management consulting, got tricked into starting a startup, and now I work for the evil side. Okay, with that said, so one of the things that founders, when watch founders do, especially when we're networking with investors, I'm just like, oh my goodness, because what what we do, and I used to be a founder too, so I've also made similar, I guess, mistakes. But what we tend to do is we get into a mindset where we don't realize that how we're doing things is outside of the way just humans in general do things. So, for example, when we go to a networking event and we talk to an investor, we end up verbally vomiting on them, basically our entire startup, and we're trying to cram all this information in like 2 minutes that we have. Hopefully that they listen, hopefully that they retain some of this information, and hopefully they're like, "This is amazing, we want to invest," or "This is amazing, we want to keep in touch." But the thing is, generally speaking, humans don't operate like that. One, if you take a step back and put yourself into just like your normal life situation, like if you're going on a first date or your friends are introducing you to a friend of a friend, we usually don't monopolize the conversation. We usually don't spit out our entire life story within the first 5 minutes, and then we usually don't expect something back from them, like, "Can you please give me money?" And so something to think about while we're talking to investors is, one, we make decisions emotionally, and this is humans across the board. So this also includes founders. This also includes investors. And I love this quote because genuinely, we will forget what you said. We will forget kind of what you did, but we will not forget how people made us feel, and founders the same, how people make you feel as well. So with that said, couple things to give you a little bit of context of what I mean by this is I see maybe about 400 to 800 founders a week. So I have meetings about 30 to 80, deck reviews about 150 to 200, networking events 20 to 40, and then cold and warm emails I get 50 to 75 a day. So if you smash that all together, it's about 400 to 800 founders. So my question back to you is, if you had to interview 400 to 800 customers in 1 week, how many of them will you actually remember? How many of them will you remember what they said and actually who they are? And so, wanting you guys to, as we're kind of level setting and fundraising, is to think about that, is to think about, we see so many founders. How do you stick out with all of these, with all the founders that we see? And so my biggest recommendation to founders is think like you're a small fish in a big pond. Time and time again, when I talk to founders, almost, I want to say 98% of the founders I meet, they all think that they're a big fish in a small pond. We're first to market. No one else has this product. No one else is doing this kind of product that we're doing. We're doing something really unique. All of these like pontifications of how things are great. But the thing is when we start thinking like that, then we're relying on the things that we're holding on to. So like first to market, and thinking that no one else is doing what we're doing. Well, I can guarantee you, there are very, 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 very few ideas that are new, whether it be from a product standpoint, or from features, or from tech, or from outcomes, even. And so, if you were to strip away all of these common things like first to market, or we didn't have to market to anyone, all these things that a lot of the founders say, what do you have left? So that's number two that I wanted to focus on, because when you start thinking like a small fish in a big pond, you start thinking more about what is it that you actually have that no one else has. So the other thing is our recall memory, humans in general, our recall memory is really, really bad. And so it's kind of like Jeopardy. Someone asks a question and you're like, oh, I know this, and you just can't figure it out within like the 10 seconds. So context is really important. And remember, even if it's seems repetitious, repetition is good if you want us to remember. And that's the key here, is you want us to remember. When we say get your foot in the door, that means you want us to remember you and be like, okay, we want to meet with you. Because most likely we won't say yes the first time around. We'll say, hey, send me your pitch deck. And then investors are human. A good resource to look at is inverse thinking. It really helps people to ask the opposite questions, which is a bit different. All right. Next. Why is this? Okay. Nope. All right. Context. Oh, I just realized I'm not advancing your slides. Fundraising. Oh, did someone have a question? Marianne, how are we doing
Yeah, so
questions?
we're going to take the questions at the end.
Okay.
So I want to talk a little bit about this one because so many founders come to me and they're like, Marianne, can you introduce me to investors? But then what they don't realize is with an investor, you typically get one shot, and you probably are not ready to pitch to investors. You got to make sure that you have an investor readiness checklist. That means that all of these needs to be taken care of for you to go and pitch to investors. So one of the thing is, have you done like market and competitive analysis, right? Have you set up like a pricing strategy, a marketing strategy? Even if you don't include it in the deck, investors are going to start digging in, especially in the due diligence process. So you need to make sure to be able to answer that. What are your current marketing strategies and channels, right? Do you have that figured out? What are your traction and metric assessment, right? What are your valuation and funding requirements? And then also another thing is like once you kind of start pitching to investors, you got to have an action plan on how to pitch to investors. And an action plan can say, okay, you know what? I have the list of 150 investors that I'm going to pitch to, and they are all in an Excel sheet somewhere. And that's your action plan. I'm going to go and pitch to every single one of them within like a short period of time. And then once you start like pitching to investor, you're going to get a lot of like actionable recommendation that then you can use to start pitching to next investors. So like you can go to maybe not the tier one, don't start with tier one investors, obviously. Go to investors that you can get feedback from. So then you can have an action plan and recommendation that you can take on and just improve on it. Let's go to the next slide. And then
Actually,
another thing also that,
there
yeah, and Jenny, did you want to talk more about some stuff here?
Yeah, there was just one thing, a couple things. So fundraising, some of the cadences, a lot of founders come up to me and they're like, well, what do we do on a regular basis and how do we increase our network? And so for the people who aren't fundraising yet, and I guess for the people who are, when you meet someone, start a CRM. Founders look at me and they're like, are you serious? But I'm like, yes, I am very, very serious. Because as you know, as you've heard, some of it's a numbers game. How do you keep track of all these investors that you've talked to if you don't have somewhere to put it in? So whether it be an Excel file, a CRM, put it all in there so you can remember. Another thing is make sure you have a beginning and an end. So if you're going to start fundraising next year, you're going to start fundraising, I don't know, January 15th, and you're going to end March 15th. The reason why it's really important to do that, one, is to give yourself like push comes to shove, you're going to be done March 15th. Another thing is if you're fundraising for too long, word gets around and investors will hear that you've been fundraising for a while because we ask each other. We're like, oh, did someone so and so talk to you about this? And if we hear that you've been fundraising for too long, our immediate perception is going to be what's wrong with this company. And that's, you don't want us to think like that. Again, going back to
Oh,
humans.
hold on. People are saying that you cannot see a slide. Can you guys not see the slide? Because I can see the slides. Are you able to see the slides? Here, I'm gonna let you unmute. Can someone not see the slide? Okay, you can see the checklist. Okay, yeah. So I don't know why they put that.
Oh, it might have been because I didn't forward my second slide.
We can.
But
Okay, we couldn't. Got
yeah,
it. Okay,
okay,
sorry.
okay, perfect. And the other thing so a good goal is to have in your like Excel file or CRM or whatever you do, every week put in I'm going to meet these 5 people. I'm going to reach out to these 5 people and then slowly multiply that out. So before you know it, to what Marianne was saying, you'll have 100 people in your CRM that you've either reached out to, can reach out to, or you've identified warm connectors that will connect you. I know it sounds super obvious, and I think the things that you'll hear or will say is like seemingly super obvious. But the reason why we're talking about these things is because no matter how obvious they seem to be, I can guarantee you, many founders don't actually do some of the things that are actually obvious. So if you don't have an Excel spreadsheet or a CRM, please put it together. You are gonna thank us in the future. The other thing is newsletters. One of the things that's kind of cool about newsletters, especially if it's short and concise, is you'll have is say let's say you meet an investor now and they're like, oh, you're not ready, or oh, we think you're interesting as a founder, or we're like very interested in this company, da 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 da. 6 months later, you have a paper trail of all of the things that your company has done, ups and downs, and so they'll be able to see that. They'll have context and they'll be able to connect with you, trust that your company is actually going somewhere because it's like you have a 6-month track record that they can actually read and see. So that's one really important thing about cadence. Make sure you have that together. Pitch deck we'll talk about a little bit later. And then Marianne's about to talk about the data room. Marianne, I might chime in a couple things after you talk about the data room.
Yeah, let's talk about data
Is there
room.
is there anything you want to add
No, I think you're
about
right. Just
fundraising
don't
data?
tell investors that you're fundraising until you're actually fundraising because you don't want to be
Yes.
like 6 months you're fundraising. Then basically you're gonna be in this like dead zone. So always tell them we're thinking of fundraising in the future, start building those relationship, and then only when you're truly ready, when you have the checklist, when you have the data room, then you start telling them that you are fundraising. And then what do you mean by newsletter? Newsletter means that every like quarter, maybe you just send an email to all the investors you have been talking with, just with updates of what you're up to, so you're fresh in their mind. Um, okay,
I
awesome. So
would
now let's go to the data room. Jenny, can you move that?
Yeah. And I would say for people who are in the midst of fundraising, I would say do a newsletter once a month, but keep it really short and sweet. Bullet point highlights, bullet point things you're working on, bullet point where you're going to be in a month or where you'd like to be in a month, so that every month they can see, oh, this founder said they hit these milestones, they want to reach this. So the following month or the next month, they're like, oh, wow, they really did reach these things. So it's kind of giving them this storyline paper trail of your company.
Awesome. Yeah, that's right. Okay, let's go to the data room now. And then for the purpose of time, so the data room, it's a very specific checklist. Basically, what a data room is literally a folder that has all of these things together. Because let's say once you pitch to investor, you get a term sheet usually with like the terms of what the investors are giving you. And then from that term sheet, after you agree on a term sheet, there's this process called the due diligence process that starts. And basically, that takes anywhere from 1 month to 2 months. And then the investor will want to see your data room. So if you have it ready in advance, then the due diligence is going to take a shorter period of time. So your data room, you can start preparing even now. And typically, you have all of these things in there. And today we're going to talk a little bit about cap table and equity structure, the financial information, financial statement. So I have a workshop coming up beginning of January with a VP of finance, and she's going to tell you how to exactly do like financial statements. Today we're going to cover a little bit of cap table and equity structure. After that, I will send this recording and this slide to everybody else so you can start doing your data room. All right, let's go to the
Um,
next one.
and a couple things, other things about your data room. This is a great place to put things that aren't able to fit in your slides. So press releases, any type of social traction you've got, um, your newsletters, definitely keep them in there. And the one mistake that I see founders do, this is not a data dump. This is not a storage area. This is still, you're still marketing to us. So every folder we go to and every document we see, it should be very clear on what it is. And not a whole lot of like screenshots and explanations and things like that, because these are still quick blurbs of what you want us to understand. So make sure you have those when you start dumping in your financials, this and that, for things that aren't obvious. Okay. Cap tables. Ooh, this is so fun.
All right, just to show a hand, who here knows about cap tables? Okay, not a lot. Okay, some people don't know about cap tables, but yeah, Jenny, take it.
Okay.
So just assume most people do not know about cap tables in here.
Got it. All right. So essentially what it is, it's some form of documentation, either an Excel spreadsheet, or there's a lot of companies that kind of take care of this stuff for you, give you platforms for this. But basically what it is, it's just an Excel spreadsheet telling you who owns what and how much of it do they own. So it's all of your stock options, it's all of your equity, it's the equity the founders have, it's equity the investors have, different types of equity, different types of stock. What does your employees have, and then what are the what's available? So you've got warrants, etc. Pretty much that. So if you are looking to set up your own cap table, I highly recommend looking at some of they're kind of like Excel worksheets where you can input some of your information and it'll automatically populate for you. Especially if you're in the very, very early stages. Don't worry about the complicated ones because it's not going to help you. And then we're all going to be like, why are you including all of these things that are not relevant to you? The one, and a side note, the one thing about confusion that's not in your favor is when we're confused, it reflects badly on you. And I know that's really shitty and I know that's not fair, but that's kind of the general tone of how we're thinking through things. So this is, and if you guys want to take a screenshot, this is actually a really good starting place. I know it sounds super simplistic, but just having 10 million shares, starting enough there, the nice, easy round number, going from there. And then make sure that you want to, for some, make sure that all of your equity is 100% allocated at the beginning. And then work from there. Marianne, do you want to talk a little bit about equity splits? And then we can,
Yeah,
I guess cap tables, there's so much about cap tables. So if people have questions later, then I think that'll be easier to talk about cap tables
yeah,
rather than me going,
the
yeah,
next slide
rather
is
than me going into all of the painful details.
and literally, a cap table is just showing how many shares you have, who has what, and it can literally be an Excel sheet. A lot of people do use Carta for cap tables once, like for future rounds, but just an Excel sheet should be enough. So equity splits, okay, let's talk about it. So that's another one. So this is specifically for pre-seed, seed round. A lot of people think like, oh, okay, I'm gonna own like 100% of shares, but typically how I've seen this happen is in the pre-seed, in the founder split, typically you have like 70 to 80% of the company. Typically, you allocate 10 to 15% of that equity to future employees throughout the kind of the rest of your startup life cycle. So you want to make sure that 10 to 15 is employees. So let's say you bring in a co-founder then you probably don't want to give them, 50% because you still need to allocate this 10 to 15% in the option pool. If you are bringing a co-founder from the beginning, then typically you split it equally. But if you're, let's say, you already built the MVP, etc., depending on the co-founder and their value and what they're bringing to the table, you don't need to give them 50%, but also make sure that whatever co-founder you have, especially if you already incorporated the startup, make sure that there's a 4-year vesting period with a 1-year cap. That means that if within a 1 year, like you don't enjoy working with the founder, you can let them go, but still retain equity in your company. You don't lose control. Then in pre-seed, you're usually giving away 10 to 20% of your equity to investors. And in the seed round, probably 20 to 30% of your equity is going to investor. Your option pool is 10 to 15%. And then you typically are left with 50 to 65% of your company. That's where we hear so much of like horror stories, because like at every round you're diluting yourself. So at every round you are owning less and less of your company. So just keep that in mind. So that's a little bit about equity splits. And then next, I'm going to talk about valuation. And Jenny is going to talk a little bit later about how to value your startup. But I think what I want to show you is what are the latest trends happening now in valuations, especially in the Bay Area. And this is what I prepared for you. So if you go to the next one. What are the latest pre-seed valuations? So typically you're asking between 500K to $1 million. So it could be like 600K, 700K, depending on your network. And you are valuing your company at $5.7 million before you raise funding. After you raise funding, because you raise that funding, then typically there's a post money valuation, and it takes pre-seed startup on average 1.2 months to raise the round. So like make sure that you have enough runway to sustain yourself for at least like 14 months. And typically you're giving investors anywhere from 10% to 20%. So that's for pre-seed. At the seed stage, if you go to the next one, Jenny, then you can raise more funding at that point. You can raise between 1 million to 3 million. Also, I have seen like some AI startup now raise $7 million. Some I've seen like 14 million, and I think WordWare raised like in the 3 digits. But until you're there, you can raise $1 to 3 million. And then the deal size were record hard. Like the medium was like $3.1 million. And then the pre-money valuation is 14 million. And then it typically takes like 2.5 years to raise a seed round. And you're probably giving between like at that point, 15 to 25% of your equity. So this is it for the valuation. So Jenny, I'm gonna let you go through how to value that.
Okay. So with that said, those are baselines, and those are really, really, really good baselines to know because you need a starting point. But in all honesty, especially for pre-seed, y'all don't have the numbers to do proper valuation models. Valuation is a financial tool. And if you don't have numbers for the financial tool, then you're not really going to get anywhere. So if any of you are kind of like, shoot, how do we do this? And how do we follow what's on the internet because we don't have numbers? Good news, you can't. Bad news, if people aren't used to variables, this is not going to be fun for you. Okay, so going into that, think of valuation like dirty math. It's kind of like eBay buy it now. The seller has a price, and then the buyer has another price in mind. And then you've got a bunch of buyers who have these different prices in mind. And so now it's just a big dance of figuring out what price are you going to choose and what price are they generally going to agree with. And so in order to calculate these things, because you don't most likely don't have numbers or not enough numbers, it's going to be a lot of dirty math. It's going to be a lot of researching who has done what those numbers are, and then plus or minusing percentages from yours based on the key criteria, which I'll get into in a second. Okay, but the second thing is sober judgment. So if I were to look at your market size slide, what does that look like? What is your sum? And if you have any, if your TAM is a bazillion dollars and your sum is also a bazillion dollars, you need to go back to the drawing table. Also, if the sum is a lot of money, that looks to us, or the size is too big, that looks to us that you don't understand or you don't know who your user is, your customer, or even the size of the market. And I'll get to that in a little bit. But again, as you're figuring out where your baseline is comparison to what Marianne just said, you really need a lot of sober judgment. This is where this is a pitfall founders often do, because they overemphasize their company, or they underemphasize their company, but usually it's overemphasized. Some of the recommendations that I have or actually, these are some of the common valuation models. I'm not going to go into it too much, in part because you can just like look it up. ChatGPT can easily tell you what it is, probably better than I can. But the two ones that I'm going to, and many of them, so 4, 5, and 6 especially 4 and 5, are usually where the startups have numbers. Okay. Okay, factors influencing pre-seed valuation. So we've got, and I'm sure many of you have heard this. It's the founding team, your market opportunity, your product, what your product is, the amount of traction you do or don't have, market dynamics and trends, and then what are your investment terms? What are their investment terms? Scorecard. Okay, so I will go through a couple of them that fit more for where you guys are at. So basically, what this is just comparing yourself to where other startups that are similar to what you're doing are. And what that is you basically take another startup and you see how much they've raised, if they've raised, and then what their potential valuation is. And so you take what they've got and you compare that to what you've got. And so and so you say, okay, my management team is slightly more we have more people with they've had longer experience. They come from bigger company, like more like they come from Google, they come from Facebook. Your your MVP is further along. You've got more traction than some of these people have. Then you can increase some of the percentage weight to for you. So for example, if your product and technology is so much further along than what they are, then you would boost that number you would boost that 15% number higher. But if it's not, let's say their product is already to market, all these things, and you only have wireframes, then you want to boost that percentage lower. All right, the Berkus one. This is another thing that people tend to use. So basically what this is investors, they assign rough assessments based on the milestones that you have or haven't achieved. So the milestones are all up here. And this is and so what you do is like, if you have an idea, sound idea, then you would be between 0 and 500, et cetera. And you just go down that milestone list and see what you do and you don't have. Okay, let's go back. All right. The thing that sucks about all of this is you're like, Jenny, what the hell? Can't you just give me an easy formula that I can plug in and do? Unfortunately, because there are no numbers, there is really no formula you can have. And my biggest recommendation for you is to take a few of these models, plug them in, and see what the result for all, like let's say you do 3 of them, the result for 3. And if these 3 amounts for valuation are pretty far off, then you know somewhere you've miscalculated one of the aspects of this. I think it's a good way to determine, I guess, I guess, a good summary, a good outlook of what your valuation should be or could be, and then go from there. Another thing is that founders ask me is, and by the way, this is what I recommend to my clients and other VC founders, et cetera. But what I recommend, because a lot of founders times they assess these things for themselves, and more often than not, they assess. So what I also tell founders and then I'll segue into how this is a good networking ploy as well, is ask. Like, do your pitch your company really quickly, and then ask them. let's go back to ask them, what are their thoughts about your management team? What are their thoughts about the opportunity? What are the thoughts about the product and technology? Have them rate it. And then if you have a bunch of them, then you can also compare the responses that you're getting with your own response. Because remember, a lot of times when we're pitching our companies, it's our perception that, or it's the listener's perception that's truth, not so much our own truth, unfortunately. All right. Marianne, do you want to talk about safes?
Yeah, I'm going to talk about SAFE. So there's two ways to raise funding. One through SAFE and one is through convertible note. So typically when you raise funding, you tell investors like, listen, I'm going to give you 10%. And let's say you're valuing your company for for like $50 million. So 10% is, what is 10% of 5 million? So it's like 500,000. So that's what you're telling them. But basically, the problem with that is that you need to value your company now, right? You need to say, okay, my company is worth $50 million. But usually in pre-seed and seed, you don't really have that value yet. It takes a lot of effort to like set this value. So basically, what you're telling them is we're making an agreement that you can get equity for me at the next price round. So the next time you raise funding at like, let's say you're raising at a $10 million, then they can get equity at a discounted price, which means that the valuation is deferred to the next funding round, which is better for you also because like let's say in the next year you like have crazy growth, so that means your valuation will be much higher than what you first anticipated. And another thing also where you have your safe is that you usually give a valuation cap. That means that like let's say you grow super fast and then you're 20 million, but investors you cap it at a $5 million cap. So even if you grow much more than that, they still get as much equity as if you were valued like 5 million. So that's how you kind of structure your safe. The next way that you do that is through convertible notes, which is typically like a little bit more, a little bit harder to get to, a little bit harder because it's actually like a loan that you have. And then, so basically, the how to convertible note is you issue like 100K convertible note with like some kind of discount, and you also do a valuation cap. And then if you go to the next slide, the difference between like safe notes and convertible notes, there's a few things about them. Is that convertible notes are definitely like riskier with you, and then they usually have a maturity date. They say, okay, well, they mature within like 12 to 24 months, and then accrues interest over time. And then if like no conversion occurs, like if somehow there's no qualifying events, the investor can actually ask for repayment. And then it's more complex to set up. But for the investor, it's lower risk because you have to have a conversion, and then also there's a maturity date. So I think if you can go with safe, always go with safe, unless like you have an investor that you really, really want to get to. Um, so let's go after that.
Next slide.
Next slide. So I think now you can talk about the pitch deck because we're running a little bit out of time.
Okay. So in the context I wanted to talk about pitch decks is going back to valuation is, so how do you get this information, the seemingly very arbitrary information? Well, funny enough, you go back to your pitch deck. And on a side note, pitch decks should really be it should be a dashboard of your company. It's kind of like Spark Notes, if you guys know what that is. If you don't have a book, then you can't have Spark Notes. So if you don't have the basics of your company down, putting together a pitch deck is really, really hard. So if you're having a really challenging time putting together your pitch deck, it's most likely you haven't answered some key questions that you need to answer. So for example, pick a user group. This is just a template that I give founders, but I'm going to talk about um, some of the key slides that are really important, but founders kind of misunderstand what these slides entail. So I'm going to jump to traction. Traction for pre-seed startups is not so traction in general, as what investors we look for when we hear the word traction is it's numbers. It's very very quantitative. It's graphs. It's year month over month, year over year. What does the financials look like? How much has your revenue grown? How much has it not grown? What's your retention rate? All of these things. But as a pre-seed startup, you don't have numbers, right? It's a chicken or the egg. So how do you communicate traction? One of the best ways to do it is so rewind. Traction, a big portion of traction is validation. So do people actually want your product? And what is your proof? Did the user group you picked, do they want it? What is your proof? And so a lot of it is giving us enough information that we're trusting that you're going to do what you say you're going to do, and your company is at a place where people are actually going to buy it. We need backup for this. And so that's your traction slide. The best way to put this together is I'm assuming many of you who are about to fundraise, you probably should have done enough customer development and validation. So that is the best way to put numbers on a slide. So it's kind of like out of 100 of our user, the 100 people in our user group, we did this survey. 30% of the people said that they liked this feature. 50% of the people actually said they don't like this feature. It's okay to put in the things that they don't like because you're putting in what you've learned. And so that is a really good way to give trust, because then we're seeing, oh, we can see the highs, we can see the lows, but at the end of the day you're measuring something. That's one of the best ways to do it. Some of the other ways to do it are kind of some of the what I call vanity metrics, but where you guys are at, it's okay. So if you have a website, how many views on the website? If you have a mailing list, how many people on your mailing list? If you can even do that month over month, even better. So it's like you started in August, and then the month over growth of the people who are signing up for your newsletter or signing up on your website. That's really good ways to show traction, validation. The other piece of it is go to market. So go to market's kind of a funny thing. It actually started as a corporate concept that somehow got dumbed down to become a startup concept, but honestly, it just doesn't fit, especially for pre-seed startups. So for you, because you don't have a large product that has entirely gone to market, it's kind of like you have a product, either it hasn't gone to market or it's testing the waters. It's kind of like that soft launch of a product. And so in go to market, the best things to talk about is how are you going to get your first 100 customers? How are you going to get your first 200 eyeballs to be committed into your product? And so talk about that and think about go to market is more of like, your project plan. So, and not to say that this is what should go on your slide, but it's more of a project plan. So, in the first 6 months, I'm going to reach out to 5 organizations so I can poach their customers, or I can take on their customers, because we have complementary things we're doing. And then in the first, I don't know, 2 months, I'm going to do all of these Instagram ads. We're going to do 5 Instagram ads that are targeting these types of people with this type of verbiage, or we're going to A/B test, right? So it's a little bit more information than just we're going to do a social media campaign. We're going to do X campaign, but it's a little bit more information, because we want to know that if we are going to give you money, that we feel confident. And again, since a lot of it is feeling, which also kind of sucks, but we feel confident that when we give you this money, you know exactly what you're going to do, and what you're going to do is going to get you to your next step or next milestone. The other thing is partnerships. So it's let's say we are going to onboard 10 top influencers that have 10 million viewers, et cetera, et cetera. Or we are going to start a pilot with this B2B company, or we're going to dot 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 dot. The thing is though, is again, we see so many pitch decks, we see so many of these things. And so kind of the general thing we think, and this isn't a Jenny thing, this is kind of an everyone thing, is we're like, yeah, right. Like, unfortunately, because so many people have said these things, our initial fallback conclusion is, yeah, right. How far along are they really? And so think of this slide or think of this concept like a sales funnel. So you've got your foot in the door with two of the six groups that you want to pilot with. You've got your foot in the door. Two out of the other six you are redlining legal. Two of them, you've got an LOI, et cetera, et cetera. And if you only have your foot in the door with six of them, that's okay. Just give us a little bit of insight on how you're going to get further than a foot in the door. And so, why I'm talking about all of these things is, oh, sorry, and I forgot market size. Market size, so market size, just really quickly, is actually, Mariana, do I have time to go to market size?
I don't know if you have time because I do want to leave option like open for
Oh, okay,
questions.
perfect. I can talk about market size some other time, but the reason why I brought up these sides specifically is because the answers that you find, that you get from these slides, you're actually able to punt it back up into the valuation table. So, how you're measuring your milestones, how you're measuring your team, all these different things. Now you have some semblance of a little bit more quantifiable way to evaluate the valuation milestones to come up with something that investors will also say, oh, okay, I can see this. Let's see, team, I won't go into, but the only thing I'll say is when you talk to investors, more often than not, they will say team is one of their top two most important things. The thing though is how much time have you actually spent on your team slide in comparison to all your other slides in your deck? Probably very little. In relation. So if team is the most important thing that we look for, then your team slide should probably be a lot more better than it already is.